everybody, it's Rob Keynes from goldsilverpros.com. It is August 11th, 2021. I'm here with a very special returning guest. It is one Andy from Miles Franklin. Andy, how are you doing today?
Rob, good to see you, buddy. I'm well. It's crazy couple of days in the industry here, but always nice to spend a few minutes with you, buddy.
Yeah, I appreciate that. The reason I have you on is because you're so well versed in monetary history, gold, silver, and of course you're a dealer, so you can give us the update on what's going on. So that's kind of where I wanted to start. What's going on with gold and silver? Has it been busy for you guys? Is there a little bit of lull here due to the summer doldrums, or what are you guys seeing?
Yeah, up until Friday, we had the summer doldrums, and I think that's to be expected in an environment where people have been itching to get outside and to experience a little bit of life, you know, up at the cabin or with friends, and I totally get that, and that's normal for this industry. And then comes Friday where, you know, $4 billion in notional or some 24,000 contracts of gold at 100 ounces a piece were dumped on the market in the middle of the night, or in the access market as we move from London closed to New York open in an event where, you know, that trader would be fired, hunted down, and shot, maybe not in that order, because it guarantees the worst possible execution. And so, you know, that event sparked a rally in metals that was reminiscent of the silver squeeze at the beginning of February. The last 3 trading days, even Friday when this drop started, and then into Monday and Tuesday, the demand has been off the charts. And I attribute that to guys like you and Chris Marcus and Bix and, you know, the economic ninja and all of these people out there who are shining a light on what is really happening. You know, one of the things that's happened in 2020 and 2021 is a massive expansion of the mainstream into precious metals. Now, we're still a far cry from this being considered mainstream, but there is a much bigger swath of customers. I looked at the numbers we just updated, and we got almost 8,000 new clients in 2020. That's a decade's worth of client acquisition. This is indicative of an awakening, a global awakening. And the people who are awoken are watching guys like you, maybe a little bit me, but you and Chris and Bix and all of the people out there that are telling the truth, explaining what's happening. And so counterintuitive to what the price is telling you, that gets clubbed like that. We didn't witness anyone selling an ounce. Nobody. In fact, our phones have rung off the hook. I got 600 plus emails last night. People are frantically looking to protect themselves. And I think that they realize that something isn't right. When this migrates deeper into the mainstream, I think you will see an all-out rush, stampede into precious metals in an environment where traditional assets have all become positively correlated to one another, stocks, bonds, and real estate, against interest rates. So ultimately, as interest rates rise, the traditional forms of wealth in this country, stocks, bonds, and real estate, get clubbed, just like gold did on Monday. And I think that this is a gift. It's a subsidy. The biggest money in the world has been on a buying spree for 4 years into metals, and they use these knockdowns not only as an incentive for them or a subsidy for them to get longer, but also to make everyone else say, oh gosh, look at gold, it's lost there's no reason to buy it. It's lost its correlation with inflation. And well, heck, the bond market's telling us inflation is transitory. There's so much crap out there right now, Rob, that I think guys like you are helping this group of people, this hard asset group that's expanding, see the truth. And they're using these knockdowns as an incentive to buy on a subsidy. Now, it's interesting. If we look at right this moment, I would argue that it is the best environment to buy gold or silver we've seen in the past year, not only in spot price, but also in premium. With the summer doldrums came a drive down in premiums, and I'm very happy to see that. But I will also say, and I'm not talking as a dealer here, I'm talking specifically, everything I've ever seen is that every time we see the price get to a point where it is counterintuitively cheap, the premiums skyrocket because everyone is bargain hunting, like the 600 emails I got last night. And Everyone's bargain hunting. And like that, you've been talking to Chris, so have I. Chris has been, talking about, he sees a period of time where the dealers run out of a product and maybe sooner than later. And he's not wrong. When you run out of product, you have to go back and get more. And when you're dealing with an increase in demand and supply chain issues and shipping across the Atlantic issues and all sorts of stuff, the likelihood of there being more supply disruptions, higher premiums, and the inability to easily source product, I think, happens. But right now is by far the best entry point in 2021, not even close.
Yeah, and it's good to see, Andy, because, man, I've seen an undercurrent of dissatisfaction with gold and silver, even though we know typically summer tends to be a little bit weaker. And summer can be weaker in a lot of markets because people sometimes pull out of market, go on vacation. But it always is in gold, silver leading up to, the late summer and the fall, where you've got the love trade, people buying jewelry, you've got the Asians coming in with the purchases for ceremonies and stuff like that. And so I think people have forgotten the past maybe, and they saw the silver squeeze, and then they saw the cyclical impact on gold and silver, and they got frustrated. And I've had a lot of people frustrated saying, why isn't this going up? Why isn't this going up? And one of the things I've been telling people is you don't get into gold and silver to trade it, or if you do, it can be a fool's game unless you're one of the bullion banks and you have all the trading data. What you have to do is you have to look at this as a long-term deal. And I showed last week the gold and silver charts compared to previous bull markets, and they're literally tracing them exactly. So we're exactly where we need to be in the bull markets when you compare it with past historical gold and silver bulls. That, that Sunday night flash crash, $100 that was reported on Zero Hedge, that doesn't change that narrative at all. It's a short-term impact. And like you said, it creates this buying opportunity for people that want to buy physical. So to me, this is a great thing for us. It allows people who are on a budget to get into the precious metals at a good entry point, but it doesn't change the long-term narrative. I want to get your thoughts on that.
Yeah, I think the mistake that a lot of people make with precious metals is this isn't being disingenuous or disingenuous. It is, the mistake people make is looking at it as an investment. Now, it very well may perform like an investment and maybe like a damn good one. But what it is to me is wealth. And when you see these swings, I think it's important to take a step back and say, why? Why are they making it so difficult for the price to rise? At the same time, why is COMEX being bled dry by the sovereign wealth funds? Why are all the central banks accumulating it and taking possession of it? Why are the commercial banks doing it? The biggest money in the world is misdirecting, the no-look pass. They're misdirecting through price. The precious metals market is a grape sitting on top of a pumpkin. And, it's a tiny little market. And if they are looking to reposition, or if they are looking to keep people from freaking out and running out of dollars, or whatever the incentive is, it's easy to do with price. They just knock the price down with contracts that are make-believe. And they are trying to create a perception of reality that keeps people from running away from traditional assets, from look at the effort they're going to mask what inflation is by driving down interest rates. Who in their right mind are buying 10-year treasuries earning 1% with 5% inflation? And if you look at what John Williams is saying, 13% from Shadow Stats. It's a sucker's game. Even using their numbers, it's a 4% loss compounding over 10 years per year, every year, 4% loss per year on a 10-year treasury. The point is, and they use that as evidence that inflation is transitory and the bond market doesn't see it as a problem. They're blurring what is happening to keep people locked into traditional forms of investments and to not run away. This is the same game that we've seen for a long time. And it's frustrating. I understand that. But if I hadn't seen what I've seen over the last 4 years, where the biggest money in the world is making really a strong effort to de-dollarize and accumulate metals, I might be more concerned. But when you see the massive acquisition, the massive de-dollarization and removal of counterparty risk off the COMEX, the London Metals Exchange, the Bank of England, the New York Fed, all of these centers are delivering metal to the biggest money in the world. Price is not the issue. Look at the numbers, look at the economics, look at the fundamentals. They're screaming that it's never been more important than ever. And when you look at a Federal Reserve that is buying $150 billion a month of assets with a balance sheet that is approaching $9 trillion. In 2008, everyone thought they were crazy for spending what amounted to $90 billion a month in asset purchases on an $800 billion balance sheet. And now we're being told things are getting better and their balance sheet has grown 10 times and they are buying $150 billion a month instead of 90. And they talk about not raising interest rates until we see full employment or much closer to it, which is another bunch of crap because in 2019, we had the lowest unemployment rate we had in 50 years and they dropped interest rates 3 times. They've gotten into a cycle of having to inflate or default. It's inflate or die, as Richard Russell always used to say. So they're pulling out all the stops to keep everyone from seeing the reality of it. And so when you look at it as wealth in an environment where everything else is positively correlated to one another and inversely correlated to interest rates, there are very few places to safely go any longer. Do not look at the price as a determining factor. Look at the fundamentals and what the biggest money in the world is doing, and look at it as wealth. That's been wealth for 6,000 years. It will be wealth when the dust settles. And the fact that gold was reclassified as tier 1 only, to me, only crystallizes everything that I'm saying. The biggest money in the world would not have reclassified gold as a tier 1 reserve. Wouldn't have, had they not looked at it being an integral part of or a base from which everything else will spring up from when the dust settles. So yeah, I look at this as basically going to buy a new car or a new pair of jeans and it's on sale. Don't be bummed out. Be happy that you're getting a good deal and it's still available before it just becomes unattainable and ridiculously high premiums and prices.
I agree with pretty much all you said. And I wanted to add one thing in terms of the bond market. A lot of people think that you have to have high inflation for the bond market to default. But I just put research on my channel last week. I was doing research over the history of bonds, and it was actually for my subscriber newsletter. I put it there, but I'll hint at it here, give a little bit of the story here. 1994 $1 trillion bond loss in the U.S. market, low interest rates. You do not need high interest rates for a bond default. So people are waiting for, and first of all, like you said, the government masked the true inflation rate. We know that. I've written that in my book 12 years ago. We've known that for a long time. But you don't even need, if you're looking for inflation rates for a bond default, you don't need it. $1 trillion loss when the bond market was a lot smaller in 1994 at low interest rates. So the bond market could be in a lot more trouble than we think it is. And it's really sitting below the surface and we don't know. And there are warning signs there for my subscribers. I put out a lot of detail. There are a lot of warning signs in the bond market. So I think, we're much closer to getting to that bond default maybe than we've been in a long time. And going back to what you said, I think it's all the easy money policy, the QE, the modern monetary theory, the Keynesianism on steroids without the dollar being tied to gold. To that point, we're going to have the 50th anniversary of the Nixon decision coming up, I believe on the 15th here. I'm going to do a special on that Friday night. Did you have any comments on that 1971 Nixon taking us off the gold standard? And what did that do for gold for you in terms of its value over time?
Yeah, well, it was like $39 prior to that, a fixed rate or somewhere in that neighborhood, a fixed rate. And it changed everything. It made the dollar fiat, and the loss of purchasing power since 1971 has been egregious. It's been ridiculous. Since 1971, the standard of living in this country has been fostered by the good graces of our foreign creditors. And when you look at a country right now, that is $30 trillion in debt on balance sheet and 100 plus off balance sheet, that is all but insolvent, that is running massive levels of inflation, that is monetizing the bond market. At what point does the rest of the world stop accepting our dollars? And if you look at what all the way back to the 1400s, most world reserve currencies have a lifespan of between 40 and 50 years. We're on borrowed time if you realize we severed that gold tie to the currency over 50 years ago. And so I think what it did was it put the US on a stopwatch, on a time clock, where if I had to guess, we see singular world reserve status challenged And I've been saying publicly for over a year now that it is my strong belief that it emanates from the BRICS nations, from China. Alistair McLeod the other day said he believes they have 38,000 tons of gold, 5 times what we supposedly have. No one would know because they don't audit Fort Knox. But 38,000 tons of gold, 20 by the state, 18 by the people. And the things that they are putting in place, the Shanghai Gold Exchange, the Petro Yuan bond, the system that mirrors the SWIFT system, and now the largest infrastructure project in human history with the Belt Road Initiative that is connecting 70% of human population using a new digital currency, the digital yuan, to settle all these contracts. You're indoctrinating 3/4 of the world into a new currency. The world is growing tired of the dollar being the singular world reserve status when they mismanage it the way that they do. And when you talk about the US, I was looking at their balance sheet the other day. You probably know this, but maybe your listeners don't. Do you know what the largest single asset is according to their balance sheet 2021 of the United States?
It'd have to be some form of debt, right?
Student debt is the largest single asset according to the United States right now. 34.7% of our assets is the debt of our children, $1.58 trillion. So the world reserve currency has a liability of over $100 trillion, both on and off balance sheet, against an asset base of $4 trillion, of which a third of it is student debt. It's a precarious position we find ourselves in. And I think people need to think about that when they talk about being upset that gold and silver have come down. How about the fact that Social Security right now is 56 trillion underwater? And the geniuses at the Social Security Administration last year decreased their forecast on inflation, and expectations of 2.5% were put into place. Well, not only have half the number of workers been employed in the last year, but they decreased the inflation expectations. So, you're talking about an escalation of it running out of money, was projected to run out of money in 2030. You have to be your own Social Security. You have to be your own annuity. You have to be your own central banker, because the steward of our currency, the people who are running things, are driving it into the ground, eviscerating the value. And the infrastructure bill that passed last night is just another example of that, where modern monetary theory, basic universal income, and what was considered rational and normal be damned. We are a new period of time where I think if people don't own gold and silver, they're making a mistake. And if they do own it and are looking to get rich, be careful what you wish for. Because in that environment, it comes at the expense of the dollar, and everyone else that you love in this world, in this country, is going to suffer. And especially because the traditional forms of wealth, stocks, bonds, and real estate, are all now positively correlated at all-time values. Stocks and bonds used to be inverse. Now they're not. If interest rates rise, at some point they must, everything collapses. And so I think when you look at gold and silver, just know that the mathematics will bear out either a reset or a collapse, or both. And so you have metals to protect you from that. I don't think you own it to get rich. And when they fall, cost average. And I think, taken from someone who sells gold, it's probably not as easy to believe what I'm saying, but I've been doing it every 2 weeks for 31 years. And I believe in my soul that it is the road to protection in an environment where very few other assets are going to do the same thing for you. People may say cryptocurrencies. Take a look at the infrastructure bill. They're going after cryptocurrencies right now in an effort to tax the cryptocurrency exchanges. Not only that, in looking at the Biden tax bill, I've seen from my accountant that they want to start implementing Form 8300s for precious metals companies when they receive Bitcoin from the consumer. They're trying to close the door. They're trying to make all of the options or the alternatives to traditional assets and the dollar few and far between. And with the exception of cryptocurrencies and precious metals, where the heck else do you put it right now that isn't at all-time highs, most of which unjustified all-time highs? One last thing, I heard a great statement by George Gammons, and he said, we've come to a point in time where The economy is supposed to be the balloon on a hot air balloon, and the stock market, the basket underneath it. So when the balloon goes up or left or right, the basket follows it. If the balloon crashes, the basket crashes. It's inverted now. And the basket is the balloon. The stock market is the balloon. The financial markets are the balloon, and the economy is the little basket. And we've come to a point in time where all asset classes, as a result, are distorted, and price discovery is very difficult. There will come a time where Mother Nature comes in and, like Austrian economics says, sweeps the board and removes all of these distortions and misallocations in price. It's coming. Don't know when. You know, at the end of the story, Rob, the little boy does see the wolf. And I may be the poster child for the little boy who cried wolf, but I am very confident the wolf is coming. And I am not telling you to do this to get rich. And I'm not telling you to do it to protect against the end of the world. I'm just simply telling you it's been the only thing since really the beginning of time that has retained its value and been universally accepted as wealth across the entire globe.
Yeah, you may be the little boy that cried wolf, but when in high school I was called the burning bush. So I'm right there with you. It's the guy that doom and gloom before it happened. But the funny thing is, they always came true, right? I was just way ahead of the curve because for whatever reason, curse or gift, I can see far into the future by looking at world events and looking at data and things like that. And I think we're, to sum what you said, we're at our Weimar moment, we're at our Great Depression moment, where the asset markets are leading the economy and people think it's the economy when it shouldn't be. And they're not the base. The economy is the base of everything.
Right.
We know the problems in the economy. We know the unemployment. You mentioned the student loans. You said about a third or so on the balance sheet of the government. Well, guess what? Students unemployed 50% when they get out of college in their chosen field. That's not a great asset if 50% of those potentially are non-performing loans, and it's the biggest asset on our books. So when you have any sort of debt as an asset on your books, that's a problem.
Of course. And as an auditor who has audited very large companies, if anyone has the credence to say that and the reputation for that to be accepted, it's you. You know, my son, who I'm very proud of, is a senior at the Ross School of Business, University of Michigan. The only reason I sent him there when he had scholarship offers elsewhere is because it is known globally as one of the best business schools in America. And he's already got a job as a junior into a senior at Price Waterhouse when he graduates. It's an amazing deal. But I just want to use the University of Michigan as an example. The University of Michigan, a Big Ten school, is $70,000 a year. I mean, at what point do people just start saying, this is just stupid? I said it day one. And, you know, so you have a generation of kids that come out of school indebted forever. And when you hear guys like Bernie Sanders and Biden say we're going to maybe get rid of student debt, that's complete and total crap. They will not. They would get rid of a third of the asset base of the country. They won't. And anyways, the bottom line is I say it not to focus on debt, just simply to say the fragility of this country's asset base. At what point does the world look at us and say, they're completely broken, insolvent, and have the largest debt in the history of humankind? At what point do they look elsewhere? And this is the reason that we start to de-dollarize before those types of seminal moments become obvious. It's about preparing. It's like, yeah, the Titanic sank. They didn't have enough life rafts because the boat would never sink until people died and it sank. You know, I think the feeling is the exact same thing here. We don't have enough life rafts built up because everyone is invested in traditional assets and doesn't even realize that the iceberg is just over the horizon.
Yeah, that's right. It's the hubris, the overconfidence about what you're told rather than looking below the surface and seeing what's actually there. It's a perfect analogy, the Titanic. So I want to get back to the precious metal for a second. We started off talking about that. I have a couple of, friends that are big metals investors. They're seeing the premiums come down. We're starting to see some inventory flush in the system. And if we had another shock and something happened in the bond market, we had a bank default, something along those lines, something happens with the US dollar, something pretty big. Is there enough metal in the system to handle the demand that's coming? In other words, is this enough inventory right now, or is this like a temporary little amount
not
of
even
inventory?
close. Not even close, Rob. I mean, in the whole industry in the United States, there's probably, I don't know how much, I don't want to throw a number out there, but $500 million would destroy all the supply in this country like that. I mean, gone. And Rick Rule has an interesting statement, or an interesting little deal he talks about. He says that in 1980, gold was $850. The Dow Jones was briefly at 850. They crossed at 850. Last time it was 1-to-1. In that environment, there was an 8% allocation across the entire financial matrix, from Joe Sixpack to the Harvard Endowment Fund. 8% of assets were invested in metals. Over the last 40 years, that number, according to Rick today, is 0.5%. And in this environment, for the past 18 months, that small little microcosm of investors has more or less driven premiums up and gotten rid of all the available supply on a repetitive basis. If we see an event, and all we were to do was regress to the mean of the past 40 years, the average of 2.5%, it's a 5-fold increase in demand, there'd be nothing left immediately. This is a market that cannot handle hardly the demand that it has right now. Once it gets to a point where it is more widely accepted by people, no, it cannot. There just isn't enough of it, nor is the supply chains able to deal with it. Let me break it down even further. There are 6 major mints in the world that supply 95% of the product to North America and the rest of the world. There's the United States Mint, the Canadian Mint, South Africa, Australia, Austria, United Kingdom. That's it. Now, there are others out there, and there are private refineries that amount to a hill of beans. So other than that, that's it. And the reason they say there's no bull market like the gold bull market, Rob, is because it's predicated on concern and fear. And in that event, there's going to be no one selling at a big profit to go back into dollars when there's that seminal event. So in the last 3 days, we haven't had one buyback as the price has gotten clubbed, right? Not one buyback. No one's selling. This is all done on paper. So the point of it is that no, there isn't enough supply. The mints can't keep up, nor can the refiners. And this is when only, 1 out of every 20 people, 1 out of every 200 people, according to that 0.5%, own any gold or silver. So what if it's 16 people? If it goes to 8% and it's a 16-fold increase, what happens to the available supply? No, we cannot handle it. And when I tell you these are the lowest premiums I've seen really in over a year, it's true. Now, from a premium standpoint, in most cases, we're still double what we always were. Everything but the American Eagle Silver, which is more like 3 times or 4 times, 4.5 times what, and they were 8 times higher than normal at some point a few months ago. Premiums are double what they were over the last 20 years, but lower than they've been over the last 18 months. And this is a sweet spot, unless you think it just continues to get drubbed and things get better and, everything becomes rosy again. I don't, and I wish I did. But when I see an infrastructure bill that passes where only a small portion is used to make roads and bridges and airports better, and rest of it's going to wonk issues like, gender issues and issues that have nothing to do with infrastructure, I just have lost faith in the system, and I don't see things getting better anytime soon. I think we have to go through a cleansing process in order for things to get better. We're not there yet. When that event happens and people realize that one of the few places to go are precious metals, it happens overnight. Overnight, everything disappears. If someone were to spend with me $30 to $40 million, it's a lot of money, I'd have nothing left to offer anyone else tomorrow. Most companies keep between 25 and 45, 50 million of inventory, if that, or they buy it from distributors. They don't even hold it themselves. So there's just not a lot out there. If you realize there's a half a dozen decent sized precious metals companies in the United States, cumulative, they probably don't even have $300 million together. So at what point does it just disappear? A seminal moment like that, you would find very quickly, within 48 hours, everything would be gone.
I got a question from a reader talking about premiums. His question was more around when the premiums go up, are the dealers making money hand over fist? Are there other costs along the system that cause, I think there's this idea in the public that premiums go up, normal supply demand. If you ran out of meat in the supermarket, price is going to go up, right? For some reason on gold, silver, people think they're gouging. Talk about when you have shortage situations, how that increases costs along the pipeline, and why you guys are not necessarily making out hand over fist.
It's not the dealers, it's the people we buy from. It's the primary distributors. They're the ones taking the big risk. Okay, so when you're a primary distributor, let's say for the United States Mint, you're obligated to buy somewhere in the neighborhood of $50 million worth of product a year, and they're the ones taking the risk, and they're the ones who have the big expenditures, and they're the ones who, when they sell out a product, wonder where they're going to get it next and how much more they have to pay. The retail dealers are not the ones that are making out crazy, because there's far too much competition within the retail space. They are nowhere near the ones that are making the big premiums. Maybe 1% more, maybe 2% more, in an environment where we wonder, well, when I sell out of this stuff, what's the delay in getting new product? Let me just answer it another way. When I would buy over the last 18 months, it's ironic that I say this, and I've said this a lot publicly, with all of the heat going on the Perth Mint, of all the 6 major mints, they've performed best for me in selling us physical product, getting it to North America. It's like they chose their big North American wholesale business over their other areas, perhaps. But when I would buy 40,000 silver kangaroos or 50,000 silver kangaroos, I would pay for it 3 months in advance at the highest premiums I've ever paid for it, ever. I'd have to hedge it. I'd have to, deal with the logistics, deal with, am I going to sell that before I have it to the, there's so many moving pieces and so much more involved now than it ever was, that I think the dealers should make a little bit more. But it's certainly, we're not the ones making the majority of the premium. In fact, 1 or 2% at most. And the rest of it is all coming from 1 or 2 steps above us, whether it be the mints or the refineries or the primary distributors. They're making more money selling their product. It's passed on down to us and ultimately to the consumer. But no, it is not the retail companies that are gouging, not even a little bit. It's above us.
Last question for you, Andy, before we wrap up. You said premiums are lower than they were the last 18 months, but still higher than the 20-year average. Do you expect, given what's going on in the world, what we see as pending demand, do you think the premiums are ever going to go back to where they were, say, 3 or 4 years ago?
No, maybe someday. I've said publicly for the last year that this market will ultimately identify itself in 2 ways. People on the outside will say, geez, it got so expensive. Just like looking at Bitcoin. People who may have wanted to do it will say, it got too expensive, I'm not going to do it. That's how most people will look at this market. People like you and me and everyone on the inside will look at it differently, in that it's the inability to source product easily will be, I think, the defining factor for anyone who understands this industry. Because if 1 or 2 of those mints run out of product, then the other ones get swarmed and then they run out of product. And when those 6 mints run out of product, it's game over. It is. And there's just no other product out there. And at what point does that happen? I don't know. There have been times over the last 18 months, I'm surprised they even produce stuff and don't just hoard it for the governments that they reside in.
Right.
There could come a time where the governments just nationalize everything, including the mints. And I'm surprised, actually, to be honest with you, that with all of the stuff going on in this world, that the mints are still pumping stuff out. But I look at it as a gift. Don't forget, from 1933 until 1974, it was illegal to even own gold in this country. So those kind of things happen. I think you have to hope for the best, prepare for the worst. But no, I don't see premiums going back down until we have a reset of the board, until we see things go back to where price discovery becomes a little bit more natural. In an environment where the Fed is setting the back end of the bond market instead of the market doing it, where price discovery is set naturally and organically and not being manipulated. As Chris Powell will say, there are no free markets anymore, just manipulations. And until that day happens, until we see some semblance of a free market society, no, I don't see premiums going back down. Quite to the contrary, this to me is the eye of the hurricane right now. And I would think it's naive to believe that the trailing edge isn't bearing down upon us. And I'll tell you one thing, the people in this industry who have been paying attention realize that, because like I said, over the past 2.5 days, 3 days, it's just reminiscent of the silver squeeze in the beginning of February, where, you know, dealers are running out of product like that. And it can happen, and it will happen. And no, I don't. In fact, I think this is the lowest premiums we'll see all year. I think it's going to continue to move up. If there's more weakness in the metals, the premiums will go to the moon, because you have everyone bargain hunting, and there just isn't enough supply to replenish in a timely fashion.
Henny, always great to have you on. I think you're perfect at this time because of all the worry and the pain going on with the retail holder in the market. Thank you for providing your perspective. We're going to have you again at the Monetary Metals Summit, so we are going to share a screen on that. You guys can register on Hopin. The link is down below. If you want to register a free virtual conference ticket, I'll be in person on the 19th in the DFW Embassy Suites north of DFW Airport. Andy's going to be at a very special roundtable for us on the 20th, 12 p.m. to 1 p.m. with Andrew McGuire, Stuart Englert, and Daniel Vigario. That's going to be a very special one. Andy, looking forward to having you there.
Yeah,
it's going to be awesome.
Am too. I am too. Andrew McGuire is someone that I don't miss any of his shows. It'll be a real honor to be there, as it is with you. And for all you out there, that Hopin platform is fantastic. We've used it for the Sprott Show 2 years in a row. We use it with Silver, with Chris's Silverfest, and it's a really interactive, wonderful way to talk to people, both through the online chat and actually to get on there and talk face to face like we are here. So, as I said off air, Rob, and I mean it, I'm a big fan of what you do. I find you to be one of the most analytical, bright minds in this industry. I'm honored to be asked to be at your show. It's a real honor, and as it is to be here with you today. So you stay well. I look forward to chatting with you again real soon, and thanks for the opportunity.
Yep, sounds good. Thank you, Andy, so much.
You got it, man.